So given the renewed interest and volatility around the Chinese markets recently, I've been getting quite a lot of questions with regards to, hey Chiking, which ETF tracking the China market is the best? And to set the expectations straight, I don't think there is a quote-unquote best ETF that catches everything. But you just need to know what you're getting yourself into. And I've therefore decided to condense everything that I know about the China ETF market into one video and just send it to anyone who has the same question in the future. And I hope you don't call out my laziness in the comments below. You just want to skip to the ETF comparison section, you can check out in the timestamp below. Anyway, here's why investing into the Chinese stock market is tricky. First, they have so many different types of shares, and this Invesco overview says it all. You have your A shares, you have B shares, H shares, red chips, P chips, ADRs, to name a few. And at some point in time, they might just run out of alphabets to label their share types. And jokes aside, to add to the complication, you have so many different types of ETFs, trading in different currencies, tracking different type of companies. So I've took the liberty to curate and rank them accordingly, so you know what to expect. And of course, I'll share with you what I favor personally. And like any investments, there will always be risks involved. And we'll talk more about balancing the associated risks and the potential rewards in the later part of this video. Here's the thing, I believe most investors that are remotely interested in an ETF, an exchange traded fund, probably identify as some sort of a passive investor. They might not have the time, the interest, nor the skill set to look at individual companies, construct portfolios, and monitor and maintain their performances. Especially so for the Chinese market. So I don't know your motivations when you're looking for the quote-unquote best Chinese ETF, but I think some common marketing arguments from these different fund houses include the biggest reason. China is too big to ignore. And despite the recent slowdown, they're still the second largest economy. They have one of the largest rising middle class. They're a manufacturing powerhouse. And when we talk about these Chinese companies, they are en route to global expansion. And fun fact, 4 out of the top 10 apps downloaded in the US are from Chinese companies, just to name a few. And despite these achievements, globally diversified portfolios and ETFs are underweight Chinese equities. I've just did a quick search on 2 of the most commonly cited global ETFs, namely VT, which is Vanguard Total World Stock ETF, and iShares MSCI ACWI ETF. Wanna take a wild guess, hazard a guess, what's their weightage to the China geography? It's actually less than 3%. So I'm not passing a judgment on whether it should be higher or lower, but the allocation should be up to the individual investor sentiment and assessment. So an ETF like the Vanguard Total is a good start as a base and foundation. And for those of you who are interested in incorporating your own investment views and also your own outlook, you can then tweak this allocation accordingly by using different instruments. So despite being a stock picker myself, I do appreciate the role of passively investing into an index fund which serves as the base layer for my portfolio. Because it's the simplest and also the most effective way to stay invested while removing any emotions in the meantime. So before you start committing to a recurring investment, you can visualize how this investment instrument has performed in Mumu's app. So all you have to do is to go to Accounts, More, RSP calculator. Type in any ETF you want to invest in, the amount and the frequency, and you can basically backtest the returns of this quantum and also this strategy. For example, putting in $50 a week in an ETF tracking the S&P 500 from October of 2021 until today, 3 years later, your portfolio size will grow to above $10,000 with a rate of return of 29%. So truth be told, cutting back on $50 per week could just mean one less fanciful dinner outside or just buying fewer cups of coffee a week, and you'll see your portfolio grow in no time. And the trick here? Consistency. To set up your RSP today, all you need to do is to find the index you want to invest in, tap on the 3 dots at the bottom right, then tap on RSP. Key in the investment amount and select the contribution frequency, and voila, there you have it. Consistency done for you. Plus, Mumu supports instant bank transfers and currency exchanges, making the entire investment automated along the way. So new users to Mumu can earn up to 1,034 Singapore dollars worth of welcome rewards, and this includes a 6.8% per annum guaranteed returns for up to 30 days, on your first $80,000 invested with Momo Cash Plus. Please note that Momo Cash Plus is an investment product, so principal is not guaranteed, and up to 30 days of the 6.8% per annum is guaranteed only during the promotional period. So after the promotional period, interest is not guaranteed. This is not comparable and is different from a fixed deposit or a savings deposit. So investment in any capital market products involves the risk of losing your principal. And on top of that, up to 4 stock bundles of the top 5 traded US stocks worth $70 each, and an Apple share worth 287 Singapore dollars. Plus, you get up to $20 cash coupon exclusive reward when you sign up using my link below. So this would significantly help you boost your initial investment capital, and the campaign will last until the end of October. So you wouldn't want to miss this. Link to everything will be in the description below. And thank you Momo for sponsoring this video. And with that out of the way, I know some of you cannot wait. Chiking, just tell me which ETF is the best. Okay, here we go. So when investors are talking about the Chinese market, I think they generally mean one of two things. So they're probably referencing to either the Hong Kong market, where they primarily house the head share companies with a more global audience base, or the Chinese mainland market, which comprises the A-shares market. Sometimes when you hear others saying that, oh, the Chinese market is crashing, run for your life, you might want to clarify which they're referring to, because sometimes the Hong Kong market might be crashing, but the mainland market might actually be going up. So they're mostly correlated, but not to the T. So when we talk about the Chinese mainland stock market, 2 ETFs will come to mind: the CSI 300 and the A50 index. So the CSI 300 is a market cap weighted market index that replicates the performance of the top 300 stocks traded on both the Shanghai and the Shenzhen stock exchange. Basically, like how I like to put it, they're the Taobao version of the S&P 500. But instead of tracking US companies and the top 500 companies, they track 300 Chinese mainland companies. Don't ask me why 300, it's not up to my discretion. On the other hand, the A50 index comprises the 50 largest A-share companies. Basically, a much more concentrated version of the CSI 300. They filter out from 300 companies to the top 50 based on market cap as well. So when looking at ETFs tracking the CSI 300, two of the most prominent contenders are the iShares Core CSI 300, ticker 2846 or 9846, and the X-Tracker CSI 300 with the ticker ASHR or Asher for short. So when looking at ETFs, I think there are a few things to take note. Where are the ETFs listed on? What currencies they are denominated in? What are the associated fees, expense ratio, and their top 10 allocation, whether it suits what you're looking for. So when we put the two ETFs side by side, we can see a clear winner in terms of charging the least amount of fees. The iShares Core CSI 300 at 0.16%, while still tracking generally the same companies. But the downside here, the investor needs a broker that supports global coverage as it's listed in the Hong Kong exchange. So when looking at the top 10 companies that this ETF holds, it includes many of these familiar names like Moutai, which is the largest liquor company, CATL, the largest battery company, Ping An Insurance, the largest insurance company in China, Yangtze Power, the largest utility company, BYD, the largest EV company in China, so on and so forth. I think you get my point. The top 10 companies roughly accounts for 20 to 24% of the index. And of course, if you believe in a market cap weighted approach, just like the S&P 500, but this time around, the Chinese or the Taobao version, this ETF would actually reflect that view. Clearly, I would favor 2846 over the Asher ETF due to the lower expense ratio. If you want to trade Hong Kong stocks, check out Momo. So for a limited time, Singapore investors can enjoy 0 commission fees on Hong Kong stocks for 1 month. New users, you can sign up through the link below to grab this offer. And for existing users, go to Me, Promotions and My Rewards to claim your 1 month commission free card. Don't miss out. However, if you only have access to the US market, but still want something that tracks the CSI 300, but not necessarily directly, you can also consider the iShares MSCI China A ETF. And it has the ticker symbol of CNYA. So although the benchmark that they track is not necessarily the CSI 300, but instead the MSCI China A index, but if they really go through their component holdings, they are actually roughly in line with what 2846 and Asher are trying to replicate, although it comes with a small different flavor. You can see it here in the top 10 allocation. They are a little bit more heavy weighted to some of these big brand names. So the advantage to CNYA It's listed on Nasdaq, denominated in USD, and charges a lower expense ratio compared to Asher, even though it's just 0.05% cheaper. But hey, any savings on fees are welcomed, right? Now, moving on to the A50 index, which is basically just the concentrated version of the CSI 300. Similarly, we have two contenders here. Firstly, the iShares FTSE China A50, ticker 2823, or the CraneShares MSCI China A50, ticker KBA. So when looking at the top 10 allocation, you basically see the same type and same names that dominate in the CSI 300, but the allocation is essentially doubled. The top 10 names are roughly 43 to 45% of the ETF, double that of the 20% that we saw just now. So to not belabor the point, I think the Hong Kong version is the clear winner as it charges a lower expense ratio. But again, as a global investor, you need to have access to the Hong Kong market. Now, moving on to the so-called gold standard of tracking the Hong Kong stock market. It is actually via the Hong Kong Tracker Fund with the ticker 2800. So it has one of the lowest expense ratio out there at 0.07%, and they do an extremely great job in replicating the Hang Seng Index, which tracks the H-share market. So the top 10 allocations are your renowned Chinese tech companies like Alibaba, Meituan, Tencent, and Xiaomi, and the large financial players based in Hong Kong like HSBC, AIA, and even ICBC, that is China headquartered. And the only quote-unquote downside here is that they offer this only via Hong Kong dollar or renminbi, Chinese yuan denomination. So if you're looking for alternatives and one maybe a more blended approach as to how you gain exposure to some of these Hong Kong listed companies, you can actually take a look at three other ETFs that we're going to compare. So they are namely the MSCI China ETF with the ticker MCHI, the iShares China Large Cap ETF with the ticker FXI, and the iShares Core MSCI China with the ticker 2801 or 9801. So these three ETFs generally tracks the same type of companies as the Hang Seng Index, but you can see that they each have a different nuance and a different focus, depending on their weightage. So both the MCHI and the 2801 overweights heavily on Tencent, while FXI puts overweight on the big market cap guys across the board, with the top 10 holdings actually comprising nearly 60% of the weightage of the entire ETF. And on that same note, if you're interested in something even more concentrated, specific towards the tech industry for example, I don't know, maybe because you want to buy the Taobao version of the Magnificent Seven, there's actually an ETF called the iShares Hang Seng Tech ETF, which actually holds only 30 companies, and their top 10 holdings is roughly 70%, with very specific tech-related company exposure, like your usual Tencent, Alibaba, Meituan, and on top of that, Li Auto, NetEase, etc. Now, to give you a greater scope for comparison, there are other US ETFs that are trying to do something similar, like the Hang Seng Tech. An ETF like the CraneShares CSI China Internet ETF with the ticker KWEB, and the Invesco China Tech ETF with the ticker CQQQ. However, you need to be aware of one thing. Their component holdings are of very, very different makeup, just comparing these three alone. So the CQQQ, for example, don't even hold Alibaba. Therefore, you have to at least have a grasp, or at least a minimal grasp, of what are their main components and what kind of exposure do they give you from the ETF holding. And of course, you have to take into account the respective fees involved as well. Let's do a quick summary, and maybe I'll slot in at the end on what would be my ideal ETF combo for my own personal circumstances, not financial advice. So if you're interested in the CSI 300 index that tracks the 300 largest A-shares company, I will go for the iShares Core with the ticker 2846 or 9846. But if you can't buy from the Hong Kong Stock Exchange, CNYA is a good alternative. If you want a more concentrated CSI 300, you can go for the iShares FTSE China A50, ticker 2823. That basically tracks A50 instead. So if there's no Hong Kong access, KBA is a good alternative too. So for the Hong Kong market specifically, if you just want a vanilla Hang Seng Index exposure, the Hong Kong Tracker Fund 2800 is the gold standard. But if you want a slightly tech-heavy approach, you can go for the iShares Core MSCI China 2801 or 9801, or the iShares MSCI China MCHI if you don't have Hong Kong access. So for a full-scale tech exposure, considering the iShares Hang Seng Tech ETF 3067 or CraneShares China Internet KWEB, they are both good alternatives. So if you to ask me which ETF I would prefer for a complete China equity exposure, I would actually think pairing up the 9846, which is the iShares Core CSI 300, and the 9801, the iShares Core MSCI China ETF, would actually be the best. Firstly, you get both A shares and H shares exposure, basically the entire Chinese equities universe. Secondly, there's no major overlaps in terms of their biggest holdings. Thirdly, they both have relatively low expense ratio, not the lowest, but something acceptable. Fourthly, both ETFs have variations for US dollar denomination. And for those of you who are trading in the Hong Kong market, you don't have to worry, allowing for global investors to just deal mainly with two currencies, their home currency and the US dollar, without much so-called FX conversion headaches and all the necessary or associated fees involved by converting maybe the Singapore dollar to Hong Kong dollar to US dollar, so on and so forth. Lastly, I'm also personally bullish in some of the heavy hitters in the index, which will reflect relatively accurately my own personal investment view. And that's the most important thing. You should know what you're getting yourself into and not just buy the black box and hope things turn out well just by praying. So in the last section of this video, I will just highlight a few potential risk factors and upside as to why investors would be bothered about a Chinese ETF, and you be the judge. So in the last decade or so, many investors have been sold the idea that China is the next rising star, and the most obvious way to capture this upside is via its stock market. However, early investors in the Chinese market were sold a pipe dream that has yet to realize. In fact, there's been multiple instances and cases where GDP growth might not necessarily translate to stock market returns. I think quoting Jeremy Siegel, the finance professor at the Wharton School of UPenn. So the results are the same if you examine stock returns and GDP growth around the world in the last half century, from 1971 to 2020. So amongst the developed world economies, the country with the highest return has been Denmark, whose 13.5% compound annual growth rate exceeds the US by almost 3 percentage points. Yet, Denmark ties Germany for the second lowest GDP growth rate over the past 1.5 century, almost 1 full percentage point behind the United States. So China, on the other hand, has generated the fastest GDP growth, averaging 9.2% per year. Yet, the annual return on Chinese stocks has only been a measly 2.7%, the absolute lowest amongst the 18 emerging markets, unquote. Therefore, looking solely at the GDP growth alone might not be the best measure or indicator. Layering in the complex political and market dynamics with great reforms underway, who knows what will happen to the Chinese market in the years to come. So if to marry this with the whole economy and population collapse narrative troubling the Chinese markets today, no doubt when confronted with many of these arguments, any investor in the right mind would be scared. But I think the more important takeaway here is to not necessarily equate the cause and effect factor. Having higher GDP growth means that stock market returns are high, and having low GDP growth means that stock market returns will be low, as debunked by Jeremy Siegel. And on that same note, it's exactly because investors are afraid, most people are underexposed to the Chinese equities market, and the expectations being priced into this basket of Chinese stocks. They are so low now that investors are forgetting about them, and it might potentially be an opportunity, especially for those that are comfortable with the uncertainty. And not to forget, the Chinese market has been in a 3+ year bear market, suggesting low and subdued valuations. So if comparing based on the historical returns profile, the Chinese market will not seem as the most lucrative. But just note that you are comparing it to a time period of an extended bear season. And not forgetting the supposed upside of building a diversified portfolio. So here's my bottom line. I don't think you should be 100% invested in China, but I don't think you should ignore it as well. So find an allocation that you're comfortable with and just adjust it accordingly as you continue building your portfolio over time. So when going back to the assumption of being a passive investor, you should be building portfolio exposure for the long term. And you would be happy reaping the diversification benefits and to reap market level returns. And in my view, I think the 2 China ETF play will set you up nicely for the coming decade. So with that, I hope this video has been helpful. And if it is, don't forget to smash the like button, and I'll see you guys in the next video. Goodbye.